Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Moody's Corporation, a global integrated risk assessment firm that provides credit ratings, research, and risk analysis. Moody's plays a critical role in the financial markets by offering valuable insights into credit risk, which helps investors make informed decisions. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Moody's has been a cornerstone of the financial industry for decades. From a behavioral finance perspective, how do biases like the anchoring effect and overconfidence influence their decision-making, especially in areas like credit ratings and risk assessments?
The anchoring effect is particularly relevant to Moody's approach, especially in how they assign credit ratings. The anchoring effect refers to the tendency for people to rely heavily on the first piece of information they receive when making decisions. In the context of Moody's, initial credit ratings can serve as an anchor that influences subsequent evaluations of an entity's creditworthiness. Once a rating is established, subsequent assessments might be influenced by this initial rating, potentially leading to a bias in maintaining similar ratings even as circumstances change. This can impact how Moody's updates their ratings in response to new information. Overconfidence also plays a significant role, particularly in how Moody's approaches its methodologies and market predictions. Overconfidence refers to the tendency for people to overestimate their abilities or the accuracy of their predictions. Given Moody's long history of providing credit ratings and risk analysis, the company's analysts and leadership might exhibit strong confidence in their models and methodologies. This overconfidence can drive Moody's to rely heavily on their established frameworks, potentially underestimating the impact of unexpected market shifts or new risks that fall outside of traditional models.
And this focus on leveraging the anchoring effect and overconfidence has helped Moody's maintain its leadership position in the financial industry, appealing to both investors and institutions that rely on their assessments.
Exactly. Moody's strategic use of the anchoring effect in establishing credit ratings and overconfidence in their risk assessment methodologies appeals to investors looking for a company that provides consistent and reliable insights. However, this approach also means that Moody's must carefully manage the risks associated with market volatility, regulatory scrutiny, and the emergence of new financial products, particularly as the financial landscape continues to evolve with new challenges and opportunities.
Let's talk about diversity, equity, and inclusion at Moody's Corporation. As a major player in the financial services industry, DEI is particularly important for Moody's. How does this intersect with behavioral finance?
Moody's approach to DEI is crucial, especially as the company operates in a global and highly interconnected industry where inclusivity can drive better decision-making, innovation, and employee engagement. From a behavioral finance perspective, strong DEI initiatives can enhance Moody's ability to innovate and adapt by fostering a culture that values diversity and inclusion. A commitment to DEI allows Moody's to attract and retain top talent from various backgrounds, which is essential for maintaining its competitive edge in the financial services industry. For investors, Moody's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Moody's build stronger relationships with clients, employees, and regulators, reinforcing its brand as one that values inclusivity and ethical leadership.
Investors are increasingly considering DEI when evaluating companies, especially in industries like financial services, where the ability to foster inclusivity and trust is critical to long-term success.
That's right. By embedding DEI into their corporate culture and risk assessment strategies, Moody's not only improves its ability to serve a broad range of stakeholders but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to market adaptation, Moody's operates in a highly competitive and rapidly evolving industry. How does the company adapt to changing financial markets and regulatory environments, and what role does behavioral finance play in this?
Moody's strategy involves continuously adapting its credit rating methodologies, risk assessment tools, and market research to meet the evolving needs of financial markets while maintaining its focus on accuracy and reliability. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with market volatility, regulatory changes, and the introduction of new financial instruments. Moody's ability to understand and respond to new market trends such as the rise of sustainable finance, the increasing complexity of financial products, and the integration of advanced analytics allows it to stay relevant and competitive. By using data analytics, market research, and client feedback, Moody's can identify emerging risks and adjust its methodologies accordingly, helping to mitigate risks and capitalize on new opportunities in the financial services market.
And this adaptability is essential for Moody's, especially as they face competition from other credit rating agencies and the growing demand for more transparent and forward-looking risk assessments. Their ability to maintain their brand's relevance and leadership in a changing industry is key to their continued success.
Exactly. Moody's focus on understanding financial market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the credit rating and risk assessment industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in regulatory landscapes, technological advancements, and competitive pressures.
Now, let's compare Moody's to other companies in the credit rating and financial services sectors like S Global, Fitch Ratings, and Morningstar. How do the behavioral finance dynamics differ?
Moody's dynamics are often compared to other credit rating and financial services giants like S Global, Fitch Ratings, and Morningstar, particularly in their approach to risk assessment, market analysis, and competition. Moody's strength lies in its focus on comprehensive credit ratings and risk analysis, appealing to investors looking for a company that balances accuracy with strategic insights. S Global, with its emphasis on credit ratings, market intelligence, and indices, appeals to investors interested in a company that prioritizes comprehensive market coverage and data-driven insights. Fitch Ratings, known for its focus on credit ratings and financial analysis, attracts those looking for a company that is driving advancements in credit risk evaluation. Morningstar, with its focus on investment research and ratings, appeals to investors interested in companies that integrate financial analysis with investment advisory services. Moody's behavioral finance dynamics are shaped by its reputation for accuracy, strong market presence, and adaptability, making it an attractive option for those seeking stability and growth in the financial services industry.
And unlike Morningstar, which focuses heavily on investment research and advisory services, Moody's strength lies in its specialization in credit ratings and risk assessment, appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Moody's, the focus on comprehensive credit ratings, risk analysis, and market adaptability provides a unique value proposition in the financial services industry.
To sum up, Moody's Corporation's approach to business is deeply influenced by behavioral finance principles, whether it's through their credit rating methodologies, adaptation to changing financial markets, or their approach to DDI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Moody's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.
Right.